Hello and welcome to Deep Dive, our new series in which we try to decode some lesson on concepts in the world of finance. The financial landscape in India has witnessed many changes and has impressively evolved over time. One such idea, which was conceived in 2015, was the Gift City, with an aim to have a unified regulator, globally benchmarked regulations, and a full fledged financial ecosystem. In less than 9 years, it boasts of a turnover of 3.5 trillion US dollars, which is surprisingly equal to India's GDP. However, a lot of us do not understand the concept in its entirety. And to discuss this, I am joined in by Mr. Vaibhav Shah. Vaibhav is the head of business development strategy and international sales at Mirae Asset India AMC. Thank you, Vaibhav, for your time and joining in today.
Yeah, thanks, Mega, for inviting me for this very interesting discussion on the gift city.
So, Vaibhav, while the idea is great, but even when we talk to our investors, we feel that it hasn't gained as much popularity as it deserves. So, we'll try to set the concept right, and we'd like to understand from you what exactly is Gift City, how big is it, how is it regulated, and what are its possible implications in the world of investing to begin with?
Mega, so like you rightly pointed out, that gift city as a concept was started a few years back, and it's only in the last sort of couple of years actually that this concept has started taking shape, and a lot of investors are now accepting gift as a location. So let me sort of help understand to everyone what is gift, how does it work, and why sort of the government is very focused to get sort of money from foreign investors through the GIFT City. So GIFT City is actually called as Gujarat International Finance Tech City. It is India's only approved IFSC, or like central SEZ, I would say in some sense. And GIFT City is located between Ahmedabad and Gandhinagar. So 20 minutes away from Ahmedabad and Gandhinagar is GIFT City. GIFT City has two parts. One is the international gift city, and second is the domestic gift city. So we'll stick to the international gift city, where the incentives is given from the central government for businesses to set up business there. Like you mentioned, Mega, at the introduction only, the beauty of gift city is that it's got a unified regulator, IFSCA. So there are four different regulators in India, like you've got RBI for banking, SEBI for capital markets, IRDA for insurance, PFRDA for pension. But in the GIFT, there is one unified regulator, IFSCA, who overall oversees all aspects relating to banking, to capital markets, insurance, pension, etc. when it comes to operations within the GIFT city. So there's one unified regulator that makes sort of ease of doing business quite good for investors and business owners as well. Second is, if we were to see the foreign capital which comes into India, a large part of the foreign capital which comes into India comes through jurisdictions like Singapore, Dubai, which is either DIFC, Abu Dhabi, ADGM. It comes from Luxembourg, it comes from Mauritius, it comes from Cayman Islands, comes from US, UK, and other markets. But many of the countries that I mentioned in the earlier part of the discussion are small sort of jurisdictions, but became large because their focus was on financial markets. The idea of the government was that why should foreign capital come from a jurisdiction outside India, and why can't India have its own financial jurisdiction through which foreign capital can come and access Indian markets? And that was the idea of GIFT City. So though GIFT City, like I mentioned, is part of India, from FEMA perspective, it is considered as a jurisdiction outside India. And hence, I'll give you an example that when we were setting up a branch there and we were trying to send few laptops to our branch, between us in India and GIFT City, we had to fill up import and export requisition forms, right? So because it's not considered a part of India, from FEMA perspective, it means it's a jurisdiction outside India. And the idea is to attract foreign capital into India. Hence, when funds are launched from GIFT City, they essentially have to take an FPI license or a foreign portfolio investor license and invest into India. So FPI sort of regime follows with whoever wants to invest in the GIFT City. And the idea when I said to attract foreign capital into India is to make the regime very simple. The idea is to attract not only NRI, the NRIs can access India through many vehicles. They can do domestic mutual funds, they can do PMS, they can invest in AIFs, they can invest directly in stocks through PIS schemes. However, if you are a foreign national or a foreign corporate, and you want to access Indian markets, you'll have to invest with a global asset manager, mainly based out of India or dollar-based products. Idea is, can we attract those foreign nationals or foreign corporates to also invest in India? And hence, I believe that GIFT City is a beautiful vehicle which not only allows us to accept money from NRIs, but also potentially opens up a large market for foreign nationals and foreign sort of corporates. And to make this sort of attractive, government has done two things. One is incentivized asset managers to create a business there. So anyone who sets up a business gets a 10-year tax holiday in a period of 15 years. They can choose their period of 10 years when they want to get a tax holiday. This incentivizes business owners to set up an office there, and to incentivize investors, they made sure that the tax regime in GIFT is at par with global tax regimes for an FPI investors, or could be better than any other foreign jurisdiction. So that is again another incentive to attract foreign money. So like I said, the idea is to create India's own financial jurisdiction to attract foreign capital from foreign nationals, corporates, and NRIs. And our government policies are becoming quite friendly to make this environment very easy for investors to access Indian markets.
So, Vaibhav, I think the intent of the seriousness is very visible in the way in which they have designed various policies and structures and incentivized everyone who's probably trying to participate either as a manufacturer of the product or as an investor.
Right.
And I guess, the IFSCA introduced fund management regulations in 2022, and I think Mirae set up their office in 2023, which is commendable. So I'd like to understand from you that how have you structured it as an offering at Mirae? And if you are different from your competitors, how are you different?
Thanks, Meena, for highlighting this. So we set up our operations into 2023. We had few dollar-based products where India was sort of advising in some of those mandates. Because the regulatory framework became easy for fund managers to invest in Indian market through the GIFT City, we started sub-managing some of our offshore funds from the GIFT City. We are already managing a sort of a dollar-based India Medcap strategy from GIFT. It's a $300 million fund currently inside, where sort of the fund management dealing and everything from sub-management activities is done from the GIFT City. Like you said, fund management entity or FME regulations came in 2022. We set up our FME retail license in 2023. Sort of what differentiates us is there are other fund management houses who have taken AIF licenses or PMS license, or who have taken non-retail license, which means you can effectively take large ticket size from investors, either through the PMS or AIF route. We believed eventually the idea is to attract foreign investors to come into India. And hence we took a more broad-based license, which is FME retail, which allows us to do mutual funds, PMS, AIFs, venture funds, etc. So it's a quite a broad license that we believe help us manage different types of products. Thankfully, this year's budget, we saw that government is focused to incentivize retail mutual funds in IFSC to be also managed, and hence there is a tax break pass-through status which mutual funds get in India while managing mutual funds, which means buying and selling of shares is not taxed wherever a mutual fund buys and sells shares. That incentive has now also been extended to IFSCA or sort of entities present in the GIFT. So that's will make sure that in future you could have retail mutual funds also to be launched in the GIFT City. So currently we have two things. We have a sub-management fund that we are managing from GIFT City, a $300 million product. And second is we have an inbound fund that we launched a couple of months back. It's called as Mirae India Equity Allocation Fund. We are raising money from NRIs, foreign nationals, and corporates, and we are managing that fund from the GIFT City. And as we speak, we are speaking, planning to launch 2-3 more products, which are currently on the drawing board to provide various investment solutions for investors.
Right. Congratulations on the very commendable job there in being the first movers out there, clearly. So, Vaibhav, who's the right kind of an investor coming into a GIFT City offering in terms of time horizon, risk appetite? While we understand that, the minimum threshold right now is very high, and you did mention that, it can be reduced subsequently. Could you highlight on these things for the understanding of our investors?
Yeah. So maybe like I was mentioning in the earlier part of our discussion, the idea is not only to attract money from NRI, the idea is to attract money from foreign nationals, corporates as well. So the idea of GIFT City is to make the access to Indian markets sort of very simple. And hence, who would be the right investors? Anyone who's sort of positive on Indian markets, whether it's fixed income, whether it's real estate, whether it's equities, and wants to get and participate in the India sort of growth story, can be a potential investor into the fund. So typically, you can say the world actually opens up of investing to the GIFT City. If you see India's weightage in the world market cap, currently it's just about 2.5%. And we are hearing enough news reports, and we also focus on the government that by Amrit Kal of 2047, when we complete 100 years of our independence, that we should be among the top 1 or 2 developed nations in the world. India is already the 5th largest country in the world. But if the growth rates of India continue to be very high, maybe in the next 10-20 years, India will be a meaningful contributor to world GDP growth, and which means a large part of world market cap will also be driven by the Indian markets. With that as context, the idea is to make investment easy for foreigners and NRIs to come to access Indian markets. So I would say everyone who's not Indian can access India strategies from the GIFT City. Like you rightly mentioned, the ticket size currently is $150,000 and above. Technically, this might look as a hurdle, but I can tell you a lot of foreign nationals or NRIs living outside India, because the Indian currency is slightly weaker currency compared to some of those jurisdictions. $150,000 is not a very large sum of money to access Indian market. And when you've got expertise of Indian asset managers sitting on the ground with large investment teams, if you want to access them, I would say there are enough and more investors who would be ready to invest $150,000. Second is, like you rightly again mentioned, that hopefully in the next few months or quarters, we will have retail mutual funds also being available in the GIFT City, which means ticket sizes then can hypothetically go down to maybe $1,500, not $150,000. So then a large segment of investors can also sort of open up. So like I said, idea is to attract varied segments of investors and access Indian markets to the GIFT City. But the GIFT City also has a beautiful flexibility where fund houses can launch an outbound fund. Now, the word outbound itself means you will be investing outside India. which could be global stocks, global bonds, global ETFs, global real estate, etc. Um, and the idea is to get resident Indians, foreign nationals, corporates, anyone to invest and access global markets through the GIFT City. So as an asset manager, we are also evaluating launching a fund in the GIFT City, which will give access to resident Indians to global markets. And there are certain restrictions on how Indian retail investors are able to access global markets. So we believe GIFT City will provide that flexibility of resident investors to also access global markets. So who would be the right segment of investors? So any global investor who wants to access Indian markets can come through the GIFT City in an endowed fund. And even resident Indians and NRIs foreign national can access global markets through an outbound fund. Regulations don't permit sort of resident investors to invest in an inbound fund, which means uh, investors accessing Indian markets in dollar terms. We could sort of round tripping that you convert your money from INR to dollar and back into the country in INR terms. Otherwise, there is a lot of flexibility of different products that you can invest, and that can provide more investors a varied investment solution.
So, Vaibhav, I have two follow-up questions. One, an investor who's probably not based in India has two options. He can invest in the Indian market through an offshore fund or an ETF or participate through the GIFT City proposition. So, what are the key differences between these two? And while you did mention that, foreign nationals can also participate in the Indian market, of course, as long as they have a overall optimistic view, on in the Indian markets over a longer term. But what are the steps that are being taken to kind of, have the wallet share of such investors as well?
So, Megha, on the first part, you are absolutely right that foreign, investors can access Indian markets through ETFs or offshore funds. But the advantage I believe that Indian asset managers can provide is that a lot of the Indian asset managers here have large research teams and large investment teams covering various segments of the market. They are in touch with the entire business cycle, I would say, of businesses. So they would be doing regular meetings with managements, they would be doing regular plant visits, doing a lot of interactions with, suppliers and customers of the company that they want to do. So a lot of groundwork or primary research will be done by the investment teams sitting here in India and can give a much larger value add than a foreign asset manager sitting outside India and managing India. Because they will get maybe a different perspective on India, while the uh, investor asset manager sitting in India can get a better pulse on markets. So I think that's where I would say uh, that's an advantage. We've seen that basis performance track record of PMS or mutual fund schemes, most of the Indian managers have been able to outperform most global asset managers on a long time frame. And we believe because of a lot of focus on primary research, uh, that can definitely add more value to investors. So that I would believe is an advantage to work with an asset manager having a presence in India, managing domestic money, uh, and doing a lot of meetings daily with the relevant stakeholders in India. On your second question, the idea, like I was saying, is to attract global investors into India. And of course, foreign nationals are a very important part of that sort of puzzle that we all want to solve. The idea is to make life very easy for a global investor to come into the fund and leave whenever he wants. So what does the global investor want? He wants few things in a fund while investing. So he wants that less paperwork and documentation is required. Second, there should be complete ease of taxation, which means he doesn't have to do any taxation filing in India. And whatever is sort of the structure can manage some of these nuances very easy for him. Hence, an investor can come the day he wants and he can just sort of go back and take back his capital the day he wants. So, repatriation and other rules sort of should be very simple and money should be accepted from any sort of foreign bank. What the regulatory framework does is to make the life easy for global investors. So, any global investors who wants to directly buy stocks in India has to take a PAN card, has to do custody arrangement, has to do advance tax filing in India, and then, of course, do income tax filing in India. It's a very cumbersome process for a foreign national to do. While the gift city can give you a much flexible way of investing and accessing Indian markets, because PAN card is not a requirement for foreign nationals when they invest in gift product. So they can just declare that they don't have a PAN card and neither a PAN card or an Indian KYC is required. They're all sort of only global documents of KYC, which is either an ID or an address proof, is required. Money can come in from any foreign bank that the global investor chooses from, and the money can go back to his same bank account. So no repatriation issues are there. And the taxation in gift funds is made very easy. So CAT3 AIFs make sure that the taxation is at the fund level and not at the investor level. And hence the investor doesn't have to do any income tax filing at all in India. So that framework makes it sort of very easy for global investors to access Indian markets. These are some of the very important steps, like we keep saying, ease of doing business, which will attract foreign nationals to also invest and access Indian markets. And I think so we have the right regulatory framework to make sure that such sort of investors can access Indian markets. We've seen in our product also a lot of foreign nationals already investing in the product, which means that the comfort of investing for some of them is significantly high.
So, we have one question because you mentioned about the ease of transaction. You also mentioned about the taxation. Are these funds in Gift City, especially say your fund, open to all the foreign nationals, or there are some restriction with respect to certain countries in terms of investing here?
Sure. See, basically, these are whenever we look at investment, these are PP, private placement sort of arrangements where investors sort of public fund that sort of any investors can access. So this is only on private placement basis. The regulatory framework first allows investments from FATF approved jurisdictions of countries which are part of either the FATF grey list or blacklist are sort of not allowed to make investments in this product. So the FATF does come out with a list of countries which, according to KYC, AML guidelines, etc., are able to meet those filters. And so if the sort of jurisdiction where the investment is coming from is not part of the grey list or blacklist, you can accept money from them. However, in each country, there are regulatory frameworks on what licenses and other things are required. And as an asset manager, you might choose that I would like to access this market from sort of these sort of modes only. So there are few geographies that asset managers may choose to invest in basis their regulatory requirements and frameworks. So there are few jurisdictions most of us don't accept investments from. So these are few things that is always mentioned in the sort of PPM and offer document, which investors should sort of go through and sort of they can understand which segment of investors and jurisdictions sort of is allowed.
Got it, Vaibhav. So, Vaibhav, we have understood till now Gift City, Mirae's presence there, and also about different nuances like taxation and operations aspect. Now, my next question is about understanding your inbound fund, which is equity allocation fund. So, if you could elaborate a bit on that, what is this fund? Is there a track history to this? and how has been the performance if there is a track history?
No, Harsh, thanks for this question. And let me try and give an idea about the product that we are talking about. So the fund is called as Mirae India Equity Allocation Fund. It's a CAT3 AIF. It's an open-ended fund, so which means investors can come and access markets like a mutual fund on a daily basis. It comes out with its NAV on a daily basis, and the NAV is declared in dollar terms because the idea is to attract foreign investments into Indian markets. And like I was saying, it's a CAT3 AIF. The ticket size of the fund is in excess of $150,000, which is as per the regulatory framework. And CAT3 AIF allows investment up to a maximum 1,000 investors in this product. Now, when it comes to investing in this product, there are two different thoughts that we had while we were constructing the idea of the fund. One was, when someone wants to access Indian markets, there are essentially two questions which are there in investor's mind, which is sort of how much I should allocate in market caps, and second is how much I should allocate to themes. So the idea that we thought was, why don't we create a fund or a fund of fund which gives and addresses both these questions. So we created a fund of fund which looks at various models based on valuation, momentum factors to decide how much allocation to be done in large cap, mid cap, and small cap, which helps you determine your market cap allocation. And what are the themes investors should access in India based on current markets? So can we take a sort of a slightly higher tactical call on one or two themes? So about 80 to 100% of the allocation is on market caps, and about 20% is on themes. This is sort of quite flexible. We keep rebalancing the portfolio on a real-time basis, and we look at various factors on valuations and momentums to determine how much to allocate. So that addresses the first part of the question is, where should I be investing in market caps and themes? Now, when it comes to underlyings, what we thought was, when a global investor wants to access India, he would want to invest in a product which has a track record, or where we can show him the ability of alpha generation that we've been able to generate over a long period of time. So what we've done is that we kept the underlyings as some of our flagship funds in some of these categories, where we have a demonstrated track record of investing and creating alpha. So at the moment, say, our investments in, say, large cap is done in our fund called as Mirae Large Cap Fund. Investments in mid cap is done in, say, Mirae Mid Cap Fund, and so on and so forth. So the underlyings are funds which have a 5-year, 10-year, 15-year track record, large in size, of sort of well-demonstrated track record. They can check on the ability of the fund house to deliver good investment experience. So that's how we sort of created the product. And an advantage that we've seen is that the regulatory framework currently benefits funds where the underlyings are not stocks but funds, and hence the fund would have a much better tax efficiency, where taxation would not be there for a CAT3 where the underlyings are mutual funds. And this fund is on a private placement basis only, being a CAT3 AIF, and ticket size are $150,000. So essentially accredited or investors who understand the risk of investing in Indian markets are the sort of potential investors who can look at this product.
Wherever one of the pain points when it comes to execution has been that certain times, CAT3Fs or even PMSs, they require a lot of document signature from the investor. Though you have mentioned that things like PAN card is not mandatory, opening a bank account in India is not mandatory. You can have your foreign bank account, you can be without PAN card, and you can still invest. But is the process streamlined enough to do it online? Because here the problem is, investor is going to be in a different geography. You being a product manufacturer would be in Gift City. Advisors could be in, say, a Bangalore, Bombay, or any other place. So how does the onboarding process work in your product? And my second question is, though you have mentioned that there is a transparency of NAV which one can track and the NAV is in US dollars, how about redemption? Suppose I want to sell after 1 year, 2 years, 3 years. Is that also very streamlined, or again, there is a set of processes which I have to follow to redeem my funds?
So, Harsh, put couple of questions that you addressed. So, on ease of investing, the idea, like I was saying, foreign nationals and corporates don't need to take a PAN card. However, if an NRI has a PAN card, as per Indian regulatory framework, they have to sort of disclose that they have a PAN card. So there is no CKYC or KYC documentation required separately for gift-based funds. The documentation requirement is sort of very simple. You need an ID proof and an address proof. And many NRIs or foreign nationals will be having a passport or a tax ID or a national ID card or a utility bill or something of that sort. So these are very straightforward documents which are required to sort of onboard clients. Now, on your question that because clients will be in a different jurisdiction, in-person sort of OVD, original verified documents are required from investors, and hence there is a list of people who can do OVD, which is originally we've met the customers and verified the documents, which is sort of prescribed. So it can be done by either the asset manager has a presence in that jurisdiction or as a sales team, they can also do it. They can be done by any bank official of a FATF jurisdiction. It can be done by a high court or magistrate or the Indian embassy or a sort of a chartered accountant or lawyer who has a prescribed degree in that jurisdiction that he practices. So there is a list of people who can do OBD for the investor, and that will make sure that KYC and AML, which is one of the large risks of the quality of foreign capital, is sort of also mitigated. Each fund houses have different policies on how they would want journeys to be digital, physical, etc. The idea is that when we were sort of trying to do it, is to make it digital, which is having a very easy way to digitally also do the onboarding as well as all the requisite documents which are physically required to be signed or also taken from the investors. But I can tell you, the documentation and other processes are fairly simple because we are also managing offshore funds. And I can tell you the regime here is not operationally difficult. On your third aspect on bank, money can come in from any foreign bank account and can go back to any foreign bank account. And hence there is a lot of flexibility on which bank the investor chooses while investing. So he has to sort of mention which bank he's going to give. So he has to give a bank statement proof of the bank he is using for transacting, and the money will come from that bank and sort of go back to that same bank. On your question on redemption, each fund may have a different redemption cycle. We usually follow a 1 week redemption cycle because our underlying is mutual funds. So mutual funds have a T+2 settlement cycle. And then we have to convert money from INR to dollars and also remit money back to their foreign bank account, which usually takes slightly longer. And hence we believe sort of 1 week is the redemption cycle, which is, if you were to see most global funds, they would have a T+5 or a T+8 redemption cycle. And global investors are sort of quite okay with some of these redemption cycles. And that's against most where redemptions would also happen in gift-based funds. So I think so the overall idea is operationally it's not too difficult to sort of access Indian markets.
And there is no lock-in period. I can pay exit load on any given day, and whatever is the exit load stipulated at the beginning, and I can leave the fund partially, fully, depending on my need.
So it depends on the two things. One is the fund that you invest in, and second, the share class you invest in. So globally, you have options of launching different share classes. In our product, I can give you as an example because I can't say it for all. Our fund is an open-ended fund. So like I was saying, we do allow daily purchase and redemptions, and you can come in and exit any day. In most share classes, there are no exit rules also. So it allows ease of coming in and going out for investors. There might be some share classes which might have exit rules. That depends on what is the investor and comfort while making the investment.
Now, coming to the last part of our discussion, that is about understanding the risk. Now, when we speak to investors about gift city products, they say that gift as a concept is very, very new. What if there is a change in the government after whatever time? Will the gift still be existing? What is your view on that? And secondly, having a unified regulator, is there any risk because of that also, or it's only pros of this and no cons?
So good question, Harsh. A lot of people have this doubt. So I keep saying that there is a risk of investing as well, and there is a risk of not investing as well. India will emerge as one of the most beautiful markets to invest in over the next 10, 20 years. And Indian markets has also demonstrated in the past the ability to generate sort of handsome returns for investors. So I would say when it comes to investing, there is a risk to investing. So, and there is a risk of not investing. Now, when it comes to the regulatory risk of investing, I would believe that the idea of any government would be to attract foreign money into India. India is a country which will always need foreign capital. It's just 2-3% of the world's market cap. So there is enough scope for us to attract far more larger capital into India. I would believe it is job of or duty of any government to make easy for foreign capital to access Indian markets. Why should foreign capital come to, like we were saying at the start, countries like Singapore, Mauritius, Cayman, Luxembourg, etc. Why that money cannot come into India? So I think so. Gift City is a step that the government has taken. I would believe whether it is X government or Y government should not change the way we look at investing and how we want to attract foreign capital into India. Hopefully in future, if GIFT becomes successful, you could have maybe GIFT City 1 and GIFT City 2 or GIFT City 3, which could be part of various other places. Like, in Dubai, you have DIFC, in Abu Dhabi, you have ADGM, right? So within the same sort of country, you have different jurisdictions which provide incentives to investors to access markets. So it will be very healthy to have multiple gift cities as well. But it's a step, I would say, once taken, should never be taken back because that breaks the confidence of global investors and which no government would want to sort of take. So that's again my personal view on how sort of this should happen. Second is unified regulator a good thing or a bad thing? I would say unified regulator definitely is a good thing because it makes ease of doing business and the regulator is sort of very friendly, wants to grow this business. So they're taking feedback from all market participants to improve the framework on the way the business is carried out. However, one thing that I want to highlight is when it comes to any one of us who has a presence in the GIFT, we are also regulated by our own regulator in our country. So, for example, Mirae is an asset management company. So, in India, we also get regulated by SEBI. And my presence in the GIFT City is as a branch of my India entity. So, the regulator for my GIFT operations remain, say, IFAC. But because the GIFT is again a branch of my India entity, regulator for me also remains SEBI. Same thing would happen with a bank that they would also have RBI overlooking few things. So I would say most of the regulators in India, be it RBI, SEBI, etc., are globally well accepted regulators. Some of them are considered as one of the highest when it comes to transparency of information and the standards that they follow. And hence, having a friendly regulator in the GIFT City and another regulator in India would make things much better for investors and would make the regulatory environment very, very strong, which is the comfort a lot of investors should have when they access Indian markets.
Fair point. Vaibhav, with this, we come to the end of our discussion, and I'm sure our listeners, including us, we learned a lot from this because most of us were also not very well aware about how Gift City work, what it is, and how it's shaping up. Thanks for taking us through all of that, and I'm sure this conversation is going to add a lot of value to our listeners. Thank you so much for taking time on a busy day and helping us understand this concept. And I think with the way you have mentioned, this concept seems to be very revolutionary. And I hope in years to come, Gift City would be equal, if not better, in comparison to places like, say, Singapore, Luxembourg, Cayman, what you mentioned. Thank you so much.
Sure. And I must congratulate on this initiative that you have taken to educate people on the concept of gift, because gift as a concept currently has more questions than answers. Hopefully, we've been able to address some of the questions in today's session, but I'm sure there'll be more questions, and we would be happy to address any other questions in the future. And thanks for inviting me for today's session.